Principles of a good investment. If you have some knowledge or know a thing or two about investing, you're probably aware of some of the following principles. But if you don't have a clue, don't worry, we've got your back. We'll share with you 15 of the most important principles that will guide you in making investment decisions that will keep your investments on track. If you appreciate the video you watch and want to help us continue creating interesting content, we kindly ask you to consider the idea of subscribing to our channel and leaving us a donation to support us. Thanks to your support, we will be able to continue improving and offering you new insights. You can do it here below, through the appropriate buttons, subscribe, and thanks. If you are investment experts or have some idea, you probably know some of the following principles. However, if you have no clue, it's not a problem. Here are the 15 most important principles to guide your investment decisions and ensure your investments are on the right track. These investment principles are not in any particular order, but we believe the last one is the most important. Before we get to that point, we invite you to give us a like to learn more about the principles and how to follow them. Also, if you haven't subscribed to our channel, you're missing out on something big. Make sure you don't miss any of our videos by tapping the subscribe button and the bell icon. Let's begin. 13. Risk and return go hand in hand. A fundamental principle of all investing is that risk and return are essentially two sides of the same coin. The higher the risk, the higher the return. For example, an investment that promises a return of over 20% on the initial investment is likely riskier than an investment that guarantees a 10% return. It should also be noted that investments that rise rapidly and significantly are very risky. For example, let's say you invest in a stock that rises 50% in 1 year. It's likely that this stock is volatile and could see sharp increases followed by sharp drops. We'll talk more about this later in the video. Risk and return are like fire and oxygen. No one wants to lose their hard-earned money. But for investors willing to take risks in pursuit of higher returns, safe investments aren't so appealing. They prefer riskier investments with great profit potential, such as startups and IPOs. In this light, it's up to you to decide how to play your cards. 12. Diversification is key. One of the best ways to protect your money and generate returns when investing is to diversify your investments. Everyone knows stocks are like a roller coaster, constantly fluctuating based on market conditions and what's happening in the country. For this reason, investment gurus often recommend diversifying your investment portfolio. This means investing in different asset classes such as bonds, commodities, technology, energy, healthcare, and stocks across different sectors. If you don't want to lose money, diversification is the best way to protect your investments while allowing them to grow. By diversifying your portfolio, you can protect your investment capital from the constant market fluctuations that can easily wipe out your investment capital. 11. Reversion to the mean is a thing. This concept can create a little confusion, but it's not that complicated. It simply means that everything in our world, from the average return on investment, ROI, to average annual rainfall, generally reverts to its historical average. Let's say a stock has had an extremely positive performance over the past 3 years, consistently delivering investors an annual ROI of 28% or more, while the average return for similar stocks has been 9%. Every investor dreams of a stock that delivers 28% or more every year, but this rarely happens. As mentioned earlier, most stocks generally revert to the industry average or historical annual growth rate. In other words, even if a stock has grown 28% or more each year for 3 years, it's likely to revert to the industry average return of 9%. When analyzing stocks, most investors focus on the recent returns of the asset class rather than past trends. In doing so, they try to anticipate and predict future performance, as mean reversion occurs. Stocks that have consistently outperformed expectations for several years are bound to underperform a few years down the line. It's unlikely that investments that have historically only provided modest returns, as they have for the past 15 years or so, will suddenly turn into something great. 10. Investment costs matter. All costs matter, and even a 1% fee often goes unnoticed. Many people don't pay attention to the small fees that are supposed to be applied. A fee of just 1% may seem small, but when you do the math you'll be surprised at how much money you could be losing out on. For example, let's say you're looking for a fund manager and there are two good options. One with an annual management fee of 1.5% and the other with 0.5%. At the moment it may not seem like a big deal, but over time that small fee could turn into a loss of thousands of dollars. Investment firms that charge higher fees are thought to spend more money on research and do a better job. However, the data suggests otherwise. Investors who minimize all costs overall achieve better results. 9. Have a margin of safety when it comes to investing. Price and value are always important. One of the best principles of the art of investing is to have a margin of safety. This means buying assets at a price below the true value. Essentially, you're buying at a discount. Especially in times of recession, assets can be valued below the true worth. Buying assets below market value is an exceptional deal for investors, as it practically guarantees a return on investment. Additionally, the margin of safety protects the investor in case the asset needs to be sold immediately for any reason. We all know financial market conditions can change easily. Financial markets are sensitive to many factors. Just think about what happened with the coronavirus. Markets crashed worldwide in a short period of time. 8. Asset allocation is critical. The way investors allocate their portfolios across different asset classes is key to generating returns on their investments. Many investors fail because they pay little attention to their asset allocation strategy. Investing solely in overvalued assets risks underperforming in the long run. The key is to always evaluate all categories, overweight the overvalued ones, and underweight the undervalued ones. 7. Adopt a long-term perspective. Sure, you can make money with speculative moves in the financial markets, but more often than not you'll burn a lot of money trying to chase the next big wave. The essence and beauty of trading lies in buying an asset at a favorable price and waiting for its value to appreciate. This may take time. As Warren Buffett said, long-term investing is one of the most important investing principles, and short-term trading will only lead to lower returns and losses in the long run. Don't let sheer greed dominate your decision-making process and go with the flow of time. 6. The power of compound interest. If you're looking for exponential growth, you need to devote time to understanding the concept of compound interest. Take the time to understand how compounding works and how you can use it to double your returns. One of the most fascinating aspects of compound interest is the multiplier effect it creates on your money over time. Instead of constantly withdrawing dividends, keep your money untouched and find out how much more you can earn. Compound interest is fantastic, but it can also be harmful. Reverse compounding is devastating. For example, a 10% loss can be made up by an 11% profit, while a 50% loss requires a 100% profit to break even. Oops. 5. Risk management. Everything worthwhile in life involves some degree of risk, and investing is no exception. To minimize risk, investors use risk management strategies. Portfolio volatility is one of the main factors that can cause funds to be wiped out in an instant. This is a serious issue that investors constantly strive to work around, especially in bear markets. For those unaware, a bear market is one where stock prices are falling, triggering sell-offs. In other words, they manage risk to avoid losing money due to volatility. 4. Take control of your destiny, because no one cares about your finances as much as you do. Conflicts of interest, fraud, and unreasonable fees have made self-investing a very appealing option. Fortunately, technology and the internet have reduced fees and all other transaction costs. Plus, they provide all the information needed to make the right investment choices. There has never been a time when becoming a self-directed investor with minimal effort has been more possible. Instead of focusing on finding a fund manager or financial guru, think about what you can do on your own. You'll be surprised at how much you can save on fees and transaction costs. 3. Don't take it personally. In life you can win or lose. The beauty of investing is that you can make a little, make a lot, or lose it all. The market determines your rate of return, which may or may not be in your favor. Don't take mistakes lightly and be determined to keep investing. Never give up, because you'll never fail. 2. Keep learning and researching. There is a wealth of information available online. Use this information to learn about new trends and find new investment opportunities and channels. Most information sources are free, some paid. If you constantly monitor economic news and understand what's going on, you'll quickly become a full-fledged investor. So, to recap, keep learning. Don't take things personally. Take control of your destiny. Here is the continued translation. Be aware of volatility. Manage risk. Utilize compound interest. Think long-term. Asset allocation is critical. Have a margin of safety. Investment costs matter. Mean reversion is important. Diversification is essential. Risk and return go hand in hand. 1. The most important principle when investing is to invest regularly and continue investing even during volatile times. Don't try to time the market or pull out when prices dip. The most successful investors stick to their strategy through good times and bad. By investing consistently over many years, you'll be able to take advantage of market downturns by buying at lower prices. Staying the course and not panic selling is crucial. Keep making those regular investments and you'll be richly rewarded over the long run. That concludes the principles of good investing. I hope this translation has been clear and accurate. Please let me know if you need any clarification or have additional text to translate. Share your personal experience on today's topic with us. Write it in the comments and ask us any questions you may have. We will be happy to answer. Leave a comment so that we can perfect our creations. We will be happy with your simple like, but the most important thing is not to forget to subscribe to the channel so you don't miss the upcoming videos.